Our investment process is a long-standing, time-tested process that's been through multiple investment cycles, both fears of depression, recessions, bubbles on the other side, and of course normal economic environments. It includes 5 basic steps. The first step is a quantitative screening analysis used to identify leading business franchises. The second step is a competitive review where we ensure the sustainability of the competitive position of the business. The third step is proprietary financial statement analysis, where we're normalizing the financial statements of the companies we invest in. The fourth step uses those normalized financial statements to do a very distinct and proprietary valuation study. And the fifth step is the portfolio construction phase, where we're optimizing the portfolio and buying simply the very best risk rewards we can for our clients based on these reviews.
We're really trying to accomplish 2 things with our products. The first is we want to beat our benchmarks, we want to beat our peers, but on top of that we want to have extremely low volatility or low amounts of risk when doing it.
So there's a lot of emphasis here on low risk, making sure that we're buying leading business franchises, really good companies, typically number 1, number 2 market share position businesses in whatever the little niche they operate in. When there's a transitorily negative event, it causes the stock to be really inexpensive, and that limits the downside risk.
You have to look at a business, see who the competitors are, analyze the revenues, analyze the profits, talk to companies, talk to analysts, talk to the management teams of the individual companies, and you can get a pretty good feel for what competitive positions are, who's gaining, who's losing market share, what's a stable position and what isn't.
We can construct what we call a risk-reward ratio for every security that we track, where we can look at the upside versus the downside. And while this sounds very simple, this is actually something that I think is a big differentiator of our firm.
Intuition plays very little. It's actually very mechanical. It's very focused on accounting. There's a lot of blocking and tackling work and just studying sub-industries, who does what when, who does well when, and understanding who those companies are.
The idea is to have a universe of 300 companies, best in class, where we've already done the work ahead of time. We have fair value and downside price targets for each one of those securities, and we're just watching them every day, day in and day out. We're looking for the opportunities to get invested. So out of the 300 companies, we may have 25 to 50 in the portfolio.
We really focus on the competitive positions of individual companies, make sure that we're not caught with a company that's losing market share or an industry that's changing.
We try to create, at the end of the day, a degree of stability in a very unstable world.